Hello, this is Richard Wilson, and right now I'm coming to you from Zurich, Switzerland. I'm actually here to speak at a ultra high net worth investment and alternative investment conference that is really being put together for about 250 people to try to attract more people to doing their finance business here in Zurich, and specifically the local neighborhood or canton of Pfäffikon. So that's why I'm here, but today I wanted to talk to you about something called the core and satellite portfolio construction. This is something that is just a common term in the industry, in wealth management and investments, and it's something you really should be familiar with if you're working in finance or in the wealth management or fund management side of things. So what does a core satellite portfolio mean? This really came from a institutional approach of managing investments which can be seen as less risky, along with things such as alternative investments. So the core of the portfolio is typically constructed so it matches the quote-unquote beta of the marketplace or the overall trends and returns of the marketplace. The core portfolio might be made up of ETFs, mutual funds, index funds, could be different stocks that are picked out, but overall in the core portfolio you're trying to match market returns, hopefully beat them a little bit, and it's in the satellite portfolio that you're really looking for extra returns. Typically 55 to 85 or even 90% of the assets are invested in the core portfolio, and only 15 to 35% typically are invested in the satellite portfolio. Now, a satellite portfolio again could be made up of all different types of alternative investments, including hard assets, real estate. There could be some creative, financing partnerships or schemes put together, hedge funds, fund-to-funds, private equity funds, futures funds, CTA funds, all different types of funds which, for the amount of risk they take, should produce you extra returns. So it's just really important to know what core and satellite portfolio construction means, and just think about it as lower risk investments for 60 to 85% of the portfolio, and then a little bit, quote-unquote higher risk investments where the investor's trying to get a bit more alpha in return for their investment within that smaller kind of satellite portfolio. And so I hope that helps explain this concept, and we'll see you again soon.